Thank you all for sticking around till the end of the day on the Fintech and Innovation stage. You know what they always say, save the best for last. So I'm glad that you are all the wise people who have stuck around. But we have a very, very interesting panel today, which I think everybody at the conference would be interested in, really about the future of payments in Africa. And we're going to look at the future of payments through three lenses, being inclusion, innovation, and capital. And we have the perfect set of people up here today to speak about that. Everyone from DFIs to serial fintech entrepreneurs to private credit and private debt providers. But I would definitely do a travesty introducing the panel. So I'm going to let the esteemed panel introduce themselves, starting on the right at the end, Warren. So tell us a bit about yourself and ABC and what you guys are doing.
Good afternoon, everyone. Thank you for sticking around. I'm Warren Wheatley, the Chief Executive Officer of the Africa Bitcoin Corporation. We are Africa's first Bitcoin treasury company, listed on the Johannesburg Stock Exchange, the Namibian Securities Exchange, and soon to be listed in London. We're very involved in Bitcoin, obviously, but also private credit and the entire crypto infrastructure framework. By way of background, I'm a chartered accountant, investment banker, and I've been involved in investment banking for the last 20 years.
Thanks. Perfect. Meet, over to you.
Sure. I guess Bitcoin and DFI in the same sentence. So that's interesting already. But hi everyone, my name is Meet. I'm part of FMO, which is the Dutch Development Bank, or the DFI from the Netherlands. I am part of the venture capital team, but before that, quick intro on FMO. FMO manages 14 billion in assets under management, investing across emerging markets in debt, equity, that includes direct investments and fund investments. As part of the venture capital team, we've been investing directly in pre-Series A, Series A rounds in Africa and Asia across clean tech, climate tech, fintech, and agri and fund investments. So yeah, I look forward to the panel.
Brilliant. So if you're a founder or a GP in the audience, you know who to corner before they leave the room. But Azza, over to you.
Hi everyone, thank you for hosting. Happy to be here. So my name is Azer Songnaba. I am a co-founder and the Chief Investment Officer of Coris Finance. So Coris is an Africa-focused private credit fund. We provide growth capital to fintechs in the African market. We finance, we provide like senior secured debt to those fintechs. And we like productive assets, so basically fintechs that are making capital available to end user consumers and mainly SMEs and gig workers. And our role here is actually to promote the ecosystem and making sure that no one is left behind, that capital can actually be there for the underserved and underbanked of the African population. So really happy to be here.
That's incredible. Inclusion embodied, and we're definitely going to touch on that a little bit more. But Dave, our local serial entrepreneur turned investor.
Thanks, Brenton. Thanks for having us. So at the moment, I run a business called Numeral. So it is a Pan-African investment hub business. It's got a couple of divisions in it, private equity being one of them. So we do invest in fintech, in some microfinance, some private credit. And then we've got a couple of biotech sort of subsidiaries in the group. So more biotech and fintech focused, but predominantly African change, anything that can enable change in Africa. We've got some investments in crypto, where I see a lot happening in Africa for the payment space. And then at the end of the day, I think everyone who works in Africa is trying to find a way to get everyone on the continent to work together, pay each other, move money around, and sort of get the economies of scale, excuse the pun. So yeah, anything to do with an investment that can enable growth on the continent, both in a fintech, biotech, or a payment solution, that's where you're going to find us playing.
Brilliant, incredible. And last but not least, Josh.
Hey everyone, my name is Josh Bell. I'm working at BII, the UK's development finance institution. I'm part of the financial services group, so one of our 3 sector priorities, and within that, I'm focused on growth equity transactions in digital financial services. So this is a fairly selective portfolio of companies like MoneyPoint in Nigeria, or Paymob in Egypt, or Mkopa in Kenya, that have both a commercial model that at scale accelerates financial inclusion for, I think, very locally driven issues around credit, banking, payments, et cetera, on the merchant as well as the household side. So pleasure to be here and speaking about fintech today.
Brilliant. I mean, like I said, we have an incredible lineup of speakers for today. Really interested to dive deep. I mean, I had a illustrious introduction, so you all know who I am, but I'm not the important person on the panel today. But we're going to start off right at the end with everybody's favorite topic in Africa at the moment, and that's blockchain and crypto. So Warren, you guys at ABC have obviously seen some of these trends, but we've seen unbelievable adoption amongst the African continent when it comes to digital assets, blockchain, stablecoins, and Bitcoin especially. For those who don't know, according to Chainalysis's recent Geography of Crypto report, Nigeria was ranked 2nd globally in terms of adoption, and Africa 3rd overall. So we're seeing real adoption on the African continent across markets like Kenya, South Africa, and Nigeria, which also have clear regulatory frameworks. But what are the key drivers behind this, Warren? And how do we ensure that this results in inclusion and not just incumbents getting better margins utilizing the infrastructure?
All right, that's an interesting question. The major reason we launched ABC, or the Africa Bitcoin Corporation, is that notwithstanding the facts you just mentioned about the massive adoption, people have adopted Bitcoin as a currency in lots of aspects. In South Africa in particular, 650,000 merchants now accept Bitcoin as a currency. Not many people are able to, and are in fact in many instances prevented from using Bitcoin as a store of value or a savings vehicle. And there's a number of reasons for that. We've got exchanges in the region where you can buy Bitcoin, but Africa's plagued with a particular, we don't have sufficient savings outside of our primary residences or our pension funds and that kind of thing. And many investors are prevented from, or don't have access to discretionary savings to apply to Bitcoin out of your discretionary savings. We've created a vehicle that is accessible by pension funds, retirement funds, and other savings vehicles that are part and parcel of people's ordinary portfolios, and outside of that discretionary spend. So we've created a treasury company that gives you exposure to Bitcoin, similar to Strategy in the US, MetaPlanet in Japan, the Smarter Web company in the UK. And now you have listed, regulated, compliant access to Bitcoin and the derivatives of Bitcoin through what we do. So someone's pension fund, as an example, can now give them access to the asset class by buying an ordinary share listed on a local exchange. So right now, and the way we're doing that practically is by taking the time and the pain to be listed on different jurisdictions. We started in Johannesburg on the JSE. Just last week, we launched in Namibia, where there are no railways to Bitcoin. You can't buy Bitcoin in Namibia. And on the map or on the glide path is Nairobi, Botswana, Nigeria possibly, and various other regions. We start in with the toughest jobs first. So we go in where Bitcoin is either prohibited or there's some fractured relationship with the regulators around that. And we'll be listing in those jurisdictions so that people can get access to Bitcoin using their non-discretionary savings. It also allows for all the investors who can't touch the asset, endowments or anything else, pension funds, a lot of high net worth individuals are just nervous about the not your keys, not your coin phenomenon. we give you regulated, compliant access to the asset class.
Brilliant. So an interesting way to think about inclusion. It's not just the bottom of the pyramid. Like there's people throughout the stack who are actually excluded from participating. And then a quick follow-up on that. Apart from investment access and exposure, do you see the technology kind of rewriting the financial rails and infrastructure in Africa?
Absolutely. So when a company builds up its balance sheet to access capital markets, you have a number of options. You could bulk up your balance sheet with local assets. So if you're in Ethiopia, you might buy Ethiopian bonds or gold or oil or whatever the case may be. And though that collateral wouldn't be acceptable in South Africa, as an example. So there are very few universal assets that enjoy universal acceptance across the region. One of them is gold, but gold is notoriously difficult to custody. The other is American Treasury bonds or Treasury bills. The interest or yield on those are just too low to do anything significant with it. And then you've got digital gold or Bitcoin, where the CAGR is 30%. It makes a perfectly acceptable collateral proposition for funders across the region and, in fact, across the world. So we've opted to bolster our balance sheet using Bitcoin, given those practicalities and those principles.
Brilliant. So leading the way in the African continent, starting from South Africa. But Josh, over to you. So you mentioned that BII has backed some of the biggest fintech stories across Africa. So the likes of TimeBank, MoneyPoint, PayMob. What's the common thread that you've seen across these fintechs that have allowed them to successfully scale across multiple African markets? Because we know the fractured and siloed nature of Africa, although we often speak of it as one market, is something that we often see as a significant challenge. So how have these fintechs done it? What's been the recipe?
Yeah, it's a great question. So I'd almost qualify it initially to say that outside of maybe Wave money in Francophone Africa, we actually haven't seen many fintechs scale across Africa. Even TimeBank, their first market of next entry was outside of the continent to the Philippines. And so I think what it came down to is when we made the initial investments, we were looking at what were local pain points and problems that were contextual to each market. So in Nigeria, it was regarding uptime and reliability of payment processing. And the team at MoneyPoint just had a better proposition and technical solution to that, but it came down to then execution around that problem. With Wave in Francophone, and particularly in Senegal, it was the lack of interoperability for mobile money and high fees. And so they came with a business model that addressed that problem with a sort of lower price point and better technology, and then executed on growing that business model. Similar for TimeBank, you look at South Africa and you'd say a fairly banked country, many people sort of may have a lower sort of customer sort of experience waiting in line at an ATM, et cetera, whether it's with Nedbank or Standard Bank, whoever may be on their retail banking side. TimeBank thought, well, with maybe better distribution and partnership with the likes of Fortini Group or Pick and Pay, and some select technology and onboarding, I can scale up to get sort of 8 or 9 million total signups. And again, it was just execution of that business model. So the common thread really is around thinking around local problems and pain points, leveraging technology, and then execution. And it's one reason why I think that there's been a lack of scaling across multiple markets with a B2C proposition, because each market presents its own consumer preferences, regulatory framework, and its own incumbent competitive intensity that I think makes it difficult for there to be a Nigerian fintech that can become a sub-Saharan African fintech at scale necessarily. I think that there are pockets within certain verticals that may work, but I think in general, as an investment house, as an impact investor, we like to back winners within a certain market and have a healthy skepticism about too much international expansion.
I mean, I think that's incredibly insightful. I think your point around B2C Pan-African is very difficult. A Nigerian consumer couldn't be more different from a South African consumer. And being able to build a product that adequately services both of those is notoriously difficult. I think on the infrastructure provision piece around like aggregation, orchestration, it's a lot easier to build a business like that.
And I think that's a big focus of our investment strategy going forward is the B2B2C area around sort of cross-border payments and processing, credit enablement. I think that there's a lot of work still to be done there. And that for us as well, given that sort of there's only so much that we can do with our time and resources as a direct investing team, obviously we're drawn to then Egypt, Nigeria, Kenya, South Africa as the regional hubs, but that doesn't mean that there aren't impactful opportunities in Rwanda or Cameroon, and I think through those B2B2C propositions, we can really help the ecosystem with inclusion.
So I think touching on that credit enablement and impactful innovation piece, so we've understood the commercial viability that you guys use to assess these business models, but from a sustainability and impact perspective, what frameworks or kind of heuristics do you apply to those same businesses when assessing them across those verticals?
Yeah, it's another really great question because I think it comes down to a deal-by-deal basis. I don't think that there's one single development or impact indicator that we're looking for, but in the instance of Wave Money, so we're thinking, wow, people are being charged 4% of a transaction fee by Orange in the markets that they're operating in. All of a sudden, you have an 80% reduction on that cost to customer to a 1% flat fee, and a better use case and customer journey and a longer roadmap with the team that you can see a wider sort of inclusion story taking place on access to insurance, access to credit, different forms of savings vehicles on the Wave wallet. I think similarly with M-Kopa, it's another story of lack of access to credit while also sort of going through a lot of ups and downs with the business as they started with off-grid solar and now we're into wider contextual asset financing. But the problem was very locally driven with the local team providing that local solution to the consumers or the businesses that just weren't seeing sort of the incumbents provide that product or service. And so from an impact perspective, I again sort of put it very much in line with what are sort of the key issues on the ground in each market. From a sustainability perspective, I think this is where maybe DFIs get a little bit of a bad rap on wanting to be too impact focused necessarily, because at the end of the day, at least as a direct investment team, we want to back businesses that are perpetual, that reach scale, that are commercially viable, that evidence that you can succeed in Kenya, South Africa, Egypt, wherever it is on the continent, because that is in part our evidencing to wider global capital pools on the opportunity on the continent. And so for us, it's really how does MoneyPoint get to scale? Well, at the unit economics, do they stack up? Do they have the business plan and the capabilities to execute? And that is a rigorous commercial analysis at the end of the day.
I mean, it's incredibly insightful answer. I think perhaps too often we try to create frameworks or playbooks that are applicable to Africa, but I think what I'm hearing from you is it's really about deep knowledge of the problem, hyper-localization, and then, as it is across the board, always execution.
Yeah.
Incredibly insightful. Azza, over to you. So we've heard about how BII and to our conversations in the back meet, FMO as well, are doing great work on the equity financing piece. But, I guess if we're trying to draw a silver lining, from COVID and kind of the funding slowdown in the venture space, we've seen the real emergence of private credit and by extension venture debt really start to come into its own and become a realistic proposition of financing on the African continent. So two-part question. The first is, you guys are issuing private credit to these types of businesses. What are the fintech models that you've seen that are best suited to debt capital? And I guess you evaluate them more than just kind of predictive sustainable cash flow. So what kind of frameworks do you use when evaluating these types of businesses?
Yeah, absolutely. So I think debt, as we've all seen in the past few years, like in this tech ecosystem, is becoming a widely used tool, right? I think founders are actually getting introduced to the product, really wanting to use it to scale, because depending on who you ask, actually, but the reality is debt is still the cheapest cost of capital out there, right? When you're really looking at the capital structure of the equity, once you've given it, it's gone, right? The debt, you have like a coupon, and once you pay that, then that's it. So it became a really good tool for founders to really kind of scale, right? Scale models that the equity funding was able to really experiment, right? So for us at Chorus, we really like businesses that actually are, you mentioned it, right? Like predictable cash flows, right? Cash flows that are that you can understand, right? You really kind of get in nature of really like where is the company really kind of sourcing the revenues from. Like a big emphasis on strong unit economics, right? Making sure that like the businesses are solid from a unit economic standpoint, and also how are they actually getting to a next level, right? Like how are they scaling up and basically kind of like creating something that is of value. So you think about a lender, for example, right? So how is their portfolio actually performing, right? So do they have a good grasp of the performance of the loans that they're making to like an SME lender or like a gig worker, right? So do they have a better understanding of that? Talking about a payment company, really like what do they have like recurring transaction flows, right? Like repeat user. So it's having a good understanding of that. And that's actually very important to kind of lay the ground for the infrastructure, because for us as debt investors, sometimes we have a conflict with the equity investors. So we don't need everybody to become a unicorn, right? We want you to kind of run a business that is sound, that is solving a real problem, right? And that's really what we are looking for, right? So basically having like sound businesses out there. And I think there was a big disconnect when we look at like the early 2020s and 2021, right, where we saw a big frenzy of equity capital really kind of going out there. So you have a lot of these founders, because they raise a lot of money, they think that they're successful, right, in terms of because they raise a big equity check, I'm successful. But for us as debt investors, that's not, we don't value you based on how much you've been able to raise, right, in your last round, right? So are you able to actually like generate like economic value, right? Do you have a product that is serving a purpose? So those are the things that we are really kind of looking for.
No, I mean, incredibly insightful. To your point, scaling negative unit economics infinitum does not make a good business.
No, absolutely not.
But I think you touched on something really interesting, right? Is sometimes yourselves and the equity investors are clash in terms of what kind of incentives or outcomes we're looking for. I think we, as a VC myself, we don't see enough collaboration or joint structuring between equity and debt as a unified financing structure that we can give out to startups or to fintechs. What better collaboration would you like to see between equity and debt investors to better enable fintechs on the African continent? And after you, I'd like to open it up because a lot of us have debt facilities, pockets, etc. If anyone else on the panel wants to jump in there as well.
Yeah, I mean, it's imperative that we work together. I think that's like, I provide like debt to early stage companies. I cannot work if those companies don't have equity. Right, like we need the equity to experiment, right, like the product, right? Because as I said, debt, you need predictable cash flows. How do you have predictable cash flows if you've never done it, right? So you need like the equity to really kind of come in, experiment, and once that's done, that's when we can come in to be able to scale it. So it's very important that we work together, right? And at Chorus, we really like found that to be the case like early on. So we are spending, so like about 18 months ago, we started this program where we are partnering with a lot of VCs like in the African ecosystem. We want to talk to their portfolio companies. We want to train them, right? So we offer technical assistance in the form of a Debt 101 and 201 training, and for over the past 18 months, we trained over 150 portfolio companies of those VCs because we want to educate them about debt, right? What is debt, right? Why is debt good for you? When can debt be actually detrimental to you, right? How do you talk to a lender? Right, so what do you need to negotiate, right? So because if the ecosystem is sound and founders actually understand that, we're going to have like a good impact. And that's really the collaboration that we are starting to see with like a lot of like VCs out there. And now I think I guess I'm pretty sure that like the mentality has changed. When I go back from like 2021 to now, I think like things have really changed, right? And I remember like in 2022, late 2021, early 2022, when the equity markets were kind of like squeezing, and I mean, we call all our portfolio companies, like, guys, like we've saw business plans like a few months ago where you're going from one market to the next, to the next, to the next. I'm like, stop that, right? Like, I think we want a path, right, to profitability very early on, right? Because that's really how you can get to the next stage. And I think a lot of the VCs have also really embraced that, and we've seen a lot of VCs even going after telling their portfolio companies, let's focus on the fundamentals to kind of build something that's durable and sustainable. And the partnership is great, and we're really looking forward to kind of continuing that going forward.
No, brilliant. I can personally attest to that. All of us kind of changed tune and went back to our portfolio and we're like, what's your path to profitability? You need to see your unit economics all of a sudden.
Yes.
But does anyone else have a view on kind of better collaborative mechanics between debt and equity investors on the panel?
Yeah, maybe let me weigh in there. So as part and parcel of our balance sheet, we do credit funding to SMEs. And really what's missing is the sort of white glove service that big conglomerates get from corporate investment banks, right? And it's frustrating, time consuming, but I think it's necessary to have those conversations with the SME. You need them to understand their balance sheet as much as you understand their balance sheet and their income flows and that kind of thing. So what we find is that, you know, a structured finance solution is way better for an SME than an automated loan that prices everything at 30%, right? So I detest the model that, you know, brags that will pay out in 72 hours. You know, you can't assess credit, you can't assess risk.
100%.
In SA, we've got guys that brag that your loan will be paid out in 3 hours. That is perpetuating the problem, right? Because you need to craft solutions that fit into the cash flow profile of that particular business. My favorite example is a teacher who was running a nursery school, and her cash flow cycle ran from February, which is the first time the parents would answer a phone call, up until like mid-December. And she sat down and told us, the parents don't even answer my calls. Like on the last day of school up until like early Feb, I can't even talk to them. And my cash flow follows that cycle. And so we gave a structured loan where it was effectively repayments for a 9-month period, interest only for 3, and then restructured over. And guess what? She's never missed the payment because we structured something that works for her. So those conversations, as time consuming as they are, help you structure a debt product that actually gives them a shot at surviving and ultimately thriving.
Oh, it's incredibly insightful. Meet, so FMO invests, as does BII, through 2 mechanisms, right? So you do direct equity investments, but you also invest indirectly in these companies through funds. As a DFI, you obviously have specific goals which are over and above purely just institutional capital allocators. So how do you balance financial inclusion with commercial viability, which Josh touched on earlier, is you need both to create a sustainable perpetual vehicle. So how do you balance those 2 goals when making allocation decisions, either in funds or in direct equity?
So that's I guess there's 2 sides of this coin, right? Like when we make an investment, obviously depending on what lever do you want to pull, impact is an integrated item through the investment process, be it directs or be it funds. We wouldn't make an investment in a company that has 0 impact on the ground, right? But maybe as an example, apart from the points that were mentioned already by Josh from a DFI perspective, I think how we as the venture capital team also look at our role in these markets is, can we catalyze commercial capital to come into markets where they wouldn't go if there was not a DFI, right? Like, so 5-7 years ago, Egypt was one of the markets where we thought, okay, like there's not enough commercial capital, let's make an investment. We were actually slightly earlier in PayMob compared to BII, but that meant that there was commercial capital that came into the ecosystem, and now you start seeing signs of a lot of GPs in these markets, right? Same, for example, where we start seeing some regulatory tailwinds, markets like Ethiopia, Morocco, even Francophone Africa for that matter. So we use those lens, focus on countries where we see, okay, let a DFI like FMO or any other DFI come in, and let us also bring along like-minded fund investments which we have made, so that we can sort of catalyze the whole ecosystem, right? So that's how we look at when we make an investment.
Brilliant. And I mean, I think I really want to draw on your specific experience here. So you had the privilege of investing in Africa, but also across India. You know, we specifically when we speak to global markets, we always like to draw conclusions about Africa based on what we've seen in other emerging markets, Southeast Asia, Latin America, and of course, India. Those markets have, for now, done considerably better. But what similarities or what lessons have you seen that African fintechs can learn that you draw from your experience investing across the Indian market?
Yeah, so maybe I will also split this question because it's an interesting way, because I personally also think about it like India as an example or a leading market in terms of how we think about Africa 10 years later, right? But so 3 things that have generally stood out for us broadly, just not from a fintech perspective only, is what is regulatory overreaching and what is regulatory oversight, right? So whereas sometimes you see the Indian regulator being too vocal, too straight, at the same time, if there is no regulation, how do you manage and scale a fintech business across Africa, right? So I think in that perspective, we are now seeing at least certain countries where the regulators are very proactive, stricter controls, proactive action versus sort of after being burned, then you take an action, right? So that is one. Second is depth of local capital. I think India as an IPO market has done fairly well in the last 5 years. So we also like to see local pension funds, local family offices putting in capital in specific countries. I think if that changes in the next 5 years, as a DFI, we've also played our role, right? And third is just founder maturity. I think there are a lot of second, third time founders now coming out even in Africa. I think the lessons that they have learned from governance issues, from topics around bad practices, I think as long as these lessons are incorporated into how they build their next ventures, I think there we just see a big parallel to India as well.
No, I mean, I couldn't agree more. And specifically on the last point, we've started to see that maturity in founders really come to the fore, and it creates a significant difference in the way they build structure and approach their businesses. But Dave, our local serial entrepreneur, so you've had a front row seat to building and exiting fintech businesses in Africa. And a criticism we often get as ecosystem players, as builders, as people who are maybe, looking at the market one step removed, is that a lot of the conjectures we make sometimes are criticized as too theoretical, too hypothetical. You've had a front row seat to these realities on the ground. So what's some of, or the biggest unconventional lesson that you've learned scaling and building financial services businesses in Africa?
Sure, that's a decent question. So it's one thing about our markets, and it's an international lesson probably, but it's trust. So no matter what the brand, no matter who's delivering it, they need to build trust with the consumer. So you find the most successful players, be it fintech, lenders, entrepreneurs, if they build trust, if they build that reputation, there's a huge brand loyalty among, especially in the African markets. So if you get that right, and you get that brand loyalty, and you get that trust right, you've built a winning recipe. If you look at, and I know it's been used to death, but if you look at the Capitec model, if you look at what they've achieved over time, excuse the pun, what they've achieved, it's been really successful in creating that brand loyalty. So now you'll get customers that even if there's a new competitor come in, and I mean, we're talking Revolut, all the noise in town is Revolut is coming to South Africa. Well, I'm probably going to meet with the Revolut guys while I'm here, and I'm going to say good luck. Good luck, because truthfully, it's not Europe, it's not the UK. There's you got Capitec, you got First National Bank. South Africa is not by any means backwards in terms of our fintech or our banking platforms. We're very far advanced, and you get instant EFTs. You can transfer money. You've got Bitcoin, stable coins being transferred real time. There's a lot of that stuff already happening. So I want to see you come in and disrupt that market, because actually there's queues of people outside a Capitec branch every month that still want cash. That is actually, the proof is in the pudding. So it's a very unique thing, and we spoke about it. Everyone's kind of said the same thing here today, was these markets are very different. What you can do in South Africa, you can't necessarily do in Kenya, you can't necessarily do in Nigeria. And I've scaled businesses over multiple African countries, and I can tell you there's 100 levers. And in 20 countries, some of those levers are down and other levers are up. It's never one recipe for all. And you need the local entrepreneur, the local experience, and you need to understand your local market. And then you're going to go in and try and disrupt trust that's been built. So it's going to be difficult to shake that market. You can come in with a specific value offering. You look at a brand like Discovery in our market, which is a very well-established high LSM brand. And all they've managed to do is capture the second bank account. So the guys bank with FNB, RMB, Nedbank, one of the other players, but then they'll have a Discovery bank account for the loyalty points and to get some rewards. But that's not necessarily a great model if you want to be the primary banker. So at the end of the day, it's a different market, but I'd say one of the most unconventional things is, firstly, trust. You need to build that loyalty and that trust with your customer base, and that reputation and trust is key. And then the other thing is, everyone's talking about AI, but the other thing with AI is our market is very empathetic. So you better build AI that feels human, that has a human element to it, and then takes the human element into account. To just touch on what Warren said earlier, at the end of the day, a lot of these things are not as scalable as you'd like to think they are. You can't flip a switch and have an automated decision-making engine to do small business lending. I mean, good luck with that. There's way too many pressure points in that system. You can do it, but we'll talk about that good book and bad book in a few years' time. It's way more complicated than that. So the two most unconventional things is, and they're very closely tied. The empathetic part, where it needs to be human, relatable, and the client needs to feel engaged and feel like there's actually some genuine awareness for his concern, his problem, what he's trying to solve, and then trust. Build that reputation, build that trust. Some guys have tried to solve that by throwing huge marketing budgets at it. At the end of the day, that's not the solution. To build that trust, you actually to deliver on the service. You've actually got to deliver on the promise. You can build all the brand you like. If you're not delivering on the day-to-day experience, you're toast. Especially in Africa, you get one chance at it.
I could not agree more.
Yeah, exactly what he said.
I mean, I've learned that firsthand when Binance landed in Africa and tried to give me the European playbook, and everything failed dismally. But you know that Dave's insights are incredibly true, because as a South African, I have a second bank account, which is Discovery, for loyalty points. But we're now going to end off on a fun note. It's our rapid fire round. So in one sentence, two maximum, answer one of the following three questions. I'm going to start on this side with Josh. So what's one regulatory change that could accelerate innovation overnight in Africa? The second question, which seems to be a favorite from the convo outside, is if you had $50 million to invest in a single fintech vertical in Africa tomorrow, what would you back and why? Or the third is, in one sentence, what defines the future of payments in Africa? So you can choose any one of those three, but Josh, we're going to start with you. No pressure.
I'll do rapid and I'll do all three. So I'm actually borrow Dave. I think if you think about the future of payments in Africa, define future, I think cash is actually the future of the payments in Africa. I think it's underappreciated how cash is going to be here for us for the next 5-10 years. as the pie gets bigger in nominal terms, maybe cash as a proportion of the slice gets smaller, but it's still going to grow. And you need to have an on-off ramp digital to cash as part of building trust and services in these economies, given also the sizes of the informal economies across Africa. On the 50 million sleeve, I'd love to do a consolidation buy and build on credit enablement. There's the businesses like a Yabix or a Jumo. I think that they're all doing something different in different markets, and I think you can put them together to get to a scaled player and exit that credibly. And then the last bit on what regulatory change. Look, it's not rocket science, but it's somewhat simplicity. I use the Nigerian example with CBN. I think at some point they may have 6, 7, 8 different payment licenses between MMO, PSB, PTSP, PSSP. You need to put everything into 1 or 2 things that make it very simple for businesses to know how to operate, and then, as going back to what I said, execute well on that. So that's what I would say.
Brilliant. Well, Dave, over to you.
So I'm probably just going to hit the one that I think is going to make the biggest impact, and it's a pet project of mine. If we can open up payments between the African countries seamlessly, real time, so whether it's using stable coins, whether it's a new African Union type currency, at the end of the day, if we can trade efficiently between the African markets real time, I promise you, between the population, the infrastructure, the resources, everything we had, we'd have a winning recipe. So if we just get regulators to be like, real-time payment, bam, I bought something from you in Botswana, you got the money immediately, it'll be delivered tomorrow. And you think about it, these things are not far apart. Botswana is an hour, 45-minute flight out of Johannesburg, but try and move money between Botswana and South Africa. Good luck.
Oh, incredible.
Yeah, actually, that's what I was about to say. Yeah, so, but I pick another one, right? So in terms of regulation, I think a harmonized cross-border regulation, I think that would be super fantastic, right? In Fintech, you get your license in one part of the continent, you can actually do it again so that you don't have to repeat it everywhere you're gonna go. We got 54 economies in the continent. We want to be able to kind of work together, trade together, and be able to be there at once. So that would be one regulatory change I would love to
100%. Meet?
Let me, a bit ironical for an all-male panel to say this, but I hope there's more funding for women founders in Africa, so that potentially aids the future of finance, I guess, in a way. Yeah, let me pause there.
Beautiful, incredible. And last but not least, Warren.
I'm going to do a magic trick and answer all 3 questions with one word. Bitcoin.
Brilliant. Well, thank you so much to the incredible panelists. Hopefully it leaves you inspired about the future of fintech and payments on the African continent.
Thanks very much. Thanks, Patrick.
Thank you.